Let's pivot now and get to today's market action. Yields moving higher once again today, and that move hitting some of the big cap tech names. Our next guest says this rate breakout is just getting started. Let's bring in Julian Emanuel, BTIG's chief equity and derivative strategist. Julian, great to see you once again. I got to ask you about this news in the context of, do you think this changes the likelihood that Powell is reappointed, and what would the market reaction be if Powell were not?
The markets would likely be upset if Powell were not reappointed. And the issue here, Melissa, is that if you think about it, regardless of the largeness of what's happened here, is there going to be more or less political pressure on Jay Powell between now and the end of his term in February? And it's clearly the answer is going to be more. If you look at it, the last time there was significant political pressure on Powell was the fourth quarter of 2018, and they're not the same. But I would only say that what we saw last week from Jay Powell was the first time he's erred on the side of hawkishness since that fourth quarter of 2018. And frankly, it could be something at the margin that gets the Fed being perhaps even more aggressive than the markets thought. And from where we sit, we don't think that X of the rally of the last several days in the wake of Wednesday, that being more hawkish than the market wants or expects right now is going to serve stocks well in the near term.
You were already calling for or expecting a 10 to 15 drop by mid-October, including the turbulence that we've recently seen, Julian. At the margins, this could be additional pressure to that. And are rates the driver of this?
Rates are very much the driver of this, Melissa. If you look at it, part of the narrative is that positioning, for one, has been largely skewed towards high multiple growth. We've seen the NASDAQ outperform essentially almost directly since the last peak in yields at the end of March. But again, the Fed's dialogue, and it's not just the Fed, the Central Bank of Norway, the Bank of England are all telling you that rates need to go higher because inflation is a bigger problem than was perceived. And if you notice, that word transitory has largely disappeared in the last 4 or 5 days. And we think that that's intentional. We think there's a chance that you could certainly test the highs at 175 and look for 2% by year end. And that to us, above 175 in particular, is likely to cause equity markets to continue to feel uneasy, and there you get more pullback.
Hey, Julian, it's Dan. So the last time that the 10-year U.S. Treasury yield was at 175, the S&P was much lower. So I'm with you with your call. But let's just look at what's happened in the last week since we started to see this rate breakout. Yes, you've seen mega cap tech be a little soft, and that was the case in Q1, right, when rates were rising. But we've seen this rotation. Look what's happened with energy. Look what's happened with financials. Is that rotation enough to keep the major indices elevated? That's the problem that I have as I keep trying to short these moves. And I think we could be in a one step forward, two step back. But I'm just wondering if the rotations are enough to keep the major indices levitating.
So from our point of view, in the near term, likely no. In the longer term, yes. But again, you're looking at a tremendous amount of uncertainty. And by the way, we are overweight both energy and financials and very encouraged by their action. Energy in particular is something that we could see could still rally another 20 or 30%. It's such a low weighting in the S&P 500 that the larger index could go sideways to lower, and you still get this performance in energy. But again, it's not enough to drive the upside in the index level. And the thing that concerns us, if you look at the last half hour of today's trading, the market basically sold off in that last half hour. The flows have been very consistent from the public for the balance of 2021. That's changed in the last couple of weeks, and inflows are something that we need to sustain the upward bias. And that is something that, again, has been missing. 1 week does not make a trend. But you look at today, and it's not terribly encouraging in terms of what we expect over the near term.
Julian, great to see you. Thank you.
Thank you.
Julian Emanuel, BTIG. Karen, in a scenario, if Julian is right, in which rates get to 2% by the end of the year and markets pull back, Can financials still go higher?
I think so. If rates get to 2% by the economy sort of, us getting past Delta and the economy sort of picking up steam, maybe if there's some improvement on some of the supply chain issues, and that's why rates are at 2%, then I think that's good for financials. And so there'll be more room to run.
Yeah. Same question to you, Guy. What happens to the market, and what happens to the markets overall with rates at 2%? 10 to 15% doesn't sound that bad.
Yeah, we talked about this. No, we talked about this a while ago. And under this scenario, and this is the scenario I thought would play out. And today, at least for today, it looks like it's happening. But again, 24 hours is not a day make. But I thought rates would get to 2% by the end of the year. I thought it'd be great for banks, energy, and resources. But I thought it'd be probably bad for the broader market because the S&P 500 cannot be driven by the groups I just talked about. So I think you'll see a sell-off in the S&P 500 if rates go to 2%. And I think you'll see banks, resources, energy continue to lead.